Hi everyone, it's Jack back with another video, and today I'm going to be talking about one of my favourite businesses to talk about. That's Realty Income, the real estate investment trust. It's probably the most well-known business that provides monthly dividend. It's currently yielding around 5.1%, not far off its 52-week lows of $55. It's currently sitting around 60, way off its 52-week highs. Been a pretty poor year for this stock, down around 13.5% in the last 365 days. In the last 5 years, it's up around 15%. So it's gone from around $53 to $60. Obviously a bit of a roller coaster with highs around 75. I think it got to 80 at one point. It's a fantastic business. It's been a fantastic long-term performer. And as I mentioned, it's an excellent income play for, well, maybe psychologically for many because the monthly incomes are nice to have. But for many people who are going for actual income, monthly dividends are very, very nice to get. And this is perhaps the best company that offers that. So I'm going to be talking about the investment thesis, looking at its portfolio, what its occupancy rates are, what sets it apart from other REITs, and then its valuation, what I think of it. Like and subscribe and enjoy the content, and let's get into it. These are the four key tenets on what I think makes up the investment case of this business and why it is such a strong investment. Proven track record of returns, an almost 15% compound annual total return since its 1994 stock listing, with just a 0.5 beta versus the S&P 500. This is a significantly decreased beta, meaning excellent compound annual growth rate, above market returns with lower volatility than the market. In addition to that, they also have stability of growth and earnings. 26 of the 27 years it's been on the public markets. It has had positive earnings per share growth and a median AFFO of 5% per share growth since 1996. Both of these are absolutely excellent metrics over the long term. And just point further to this is long-term growth with relatively low volatility. They've consistently increased their dividends at now 4.4% compound annual growth rate since their listing. It's an S&P 500 Dividend Aristocrat, so it's increased every year for over 25 years. Pays these out on a monthly basis, currently at almost 5.2%, absolutely excellent. And it has a huge run rate ahead of it. Not that it's acquiring this run rate at any rate. Again, we're looking at between 5 and 10% growth moving forward. And that is probably a conservative estimation, but I think fairly realistic. But the market here, for the global net lease market, is absolutely huge. Of course, they're not going to acquire all of this, but it's a $13 trillion total addressable market. And they have $95 billion of sourced acquisition opportunities in 2022. One of the reasons this business has been able to provide outsized returns with very, very high stability is because they have a diversified, high-quality portfolio. In terms of client diversification, the largest client in terms of annualized contractual rent is Dollar General at just 4% of the portfolio. The top 20 clients don't even make up 50% of the portfolio. In terms of industry diversification as a percentage of annualized contractual rent, the largest is grocery stores at 10.2%, which are obviously extremely desirable properties to have because sun, rain or shine, you're going to need groceries. The earnings very rarely fluctuate on the negative side by a lot, so these are generally very, very safe investments from a property perspective. Property type diversification is it's mostly retail, around 82%, so again, they're benefiting from big box retail stores mainly, very little downside negative in terms of earnings. All these are very, very high quality businesses, many of them in the S&P 500, Dollar General, Walgreens, FedEx, B&Q in the FTSE 100, Sainsbury's in the FTSE 100, Tesco in the FTSE 100. In terms of geographic diversification, the largest two geographic regions in terms of rent payments is Texas and the UK at 10.3%, no other larger than 6%. It's majority US and Europe, which are geopolitically rather stable regions, and again, mainly in retail in these large Western economies where may fluctuate up on the downside, but very rarely do any of these businesses really see revenues decreasing on the low side, providing stability in rents, very few closures, increasing over time, just excellent business. This strategy of mainly large company and big box retail stores leads to exceptional portfolio occupancy, 99%, very rarely any less than 99%. The lowest it has ever been is 96%, frequently very close to 100%. This is absolutely outstanding. Across all REITs, this is pretty much best in class and some of the highest you'll ever see, particularly for a REIT of this size, with this number of clients and properties. This is truly, truly outstanding performance. Second key driver of this business performance is just its net lease business model. This sort of lease structure supports cash flow stability, more predictable revenue stream relative to other forms of retail real estate, and that's just shown in the data that Realty Income has produced. The initial length of lease is often greater than 10 years compared to less than 10 years for shopping centres and malls. The remaining average term of Realty Income's leases is around 10 years compared to 5 to 7 years for an unnamed REIT. Gross margin more than 98% compared to around 75% for the shopping centres and malls types of REITs. The responsibility for property expenses, which can obviously be a rather large expense depending on your type of client, falls on the client for Realty Income, whereas it falls on the landlord for shopping centres and malls. The volatility is very low. Maintenance capital expenditures are very low because the responsibility falls on the tenant. And reliance on anchor tenants is pretty much none because they don't have an anchor tenant. They have many clients. Again, Dollar General are large, just 4% of the portfolio. So they have many target markets, many external acquisition opportunities, and very little costs associated other than buying the property because they push that all onto the client. And their average retail property size is absolutely enormous. Now, of course, when a business performs this well over the long term, its valuation is going to reflect that. This is not an unknown business. It's very well known to many, and that is reflected in its valuation. Its 5-year average price to cash flow is around 20, significantly higher than the S&P 500 right now, even with the S&P 500 value being relatively inflated versus historic values. Its 5 years price to book value is around 2.17. Currently, we're looking around 1.38 and a price to cash flow of around 13.5. Now, these aren't perfect metrics to value REITs by any means, but we're getting an idea, particularly with the price to book, that this business's valuation has been coming down over time. This business taking a 13% hit so far in the last year has definitely helped that. Its price to forward earnings and price to earnings are not really worth looking at for REITs in my opinion. Earnings yield 2.37%, again, not a perfect way to value REITs by any means, but overall the sort of gist you should be getting here is that versus its 5-year averages, Realty Income is certainly trading at a discount to these. What is a commonly used metric to value REITs is funds from operations or price funds from operations. Funds from operations are around $4.10 by most estimates, so price funds operations is approximately 20. Right now this business has a dividend yield of 5.1%. I don't think this price to FFO is staggeringly cheap by any means, and this business right now does trade above my fair valuation based on the dividend discount model for around $50. That's putting in a 10% discount rate and a 4.5% dividend growth rate. Now, it is not objectively cheap by this model, but I think it is within a tolerance, and in fairness, I very much doubt that Realty Income is going to drop below $50 anytime soon without significant market crashing coming. The summary for me really is that this business is cheaper than it was, but it's definitely not cheap. This has been one of the rare buying opportunities to buy this business in the last couple of years. It's typically been above $60. It's probably going to continue to be above $60 as interest rates are looking like trending down in the United States, where the majority of this company's properties are, and property prices may potentially go up as if interest rates come down. Again, this being a REIT, this is a very interest rate dependent investment. It comes and goes with the property market. Over the long term, has very low volatility. This is actually a reasonably volatile year for this business compared to what it normally is. I think in the range of the 52-week low to around $60, that's kind of where I will be happy buying it, but not overall ecstatic. That's what I'm doing now. I picked up some when it was around $58. I'm probably going to pick up some more soon when it's around $60. This is exactly the type of business that I think it is worth dollar cost averaging into. But of course, that is just my opinion. You should let me know what you think in the comments down below. I implore you to talk to a registered financial advisor because, of course, I am not a registered financial advisor. You should not take my advice as such. And I implore you to do your own research and due diligence on this business, or any business for that matter. Of course, your capital is a risk when investing. Like and subscribe when you're in the video. Comment down below what you think of Realty Income. If you think there's any better monthly dividend stocks, please let me know in the comments down below. I'll see you again next time.